There are so many crosswinds that are happening out there in economic statistics and in this business environment, and it's created kind of a muddy picture. Are things going in the right direction, the wrong direction? What I want to try to bring a little bit of order, perhaps, to all this noise and see what we can tease out of the information, some insights to provide as you try to make decisions for the future. So let's talk about inflation to start with. Inflation is kind of the news of the day. We've got new inflation numbers out. Came in last month at 6%, or that's at least the annual rate, and that is what we call headline inflation, the main inflation rate, including everything. Core inflation was 5.5%. Now this is the measure where the commodities of energy and food are taken out of the numbers, so you can get a look at the price trends of everything else that don't move up and down so quickly like those commodities do. So clearly this is down from a year ago. There's no question about that. But if you look at the monthly numbers, you'll see that especially in this core inflation, the monthly numbers, it's actually been ticking up the last few months. And that is reason for concern that, yeah, compared to a year ago, it's lower, but most recent trends, it kind of looks like maybe it's not going down. And so it makes sense. You got to pull back some of the layers and see what's happening underneath the hood. Well, in the two broad categories of goods and services, they're moving literally in opposite directions. We see goods going down. Okay, the price of goods is coming down across the board in terms of the overall category, but the prices of services are going up. So these are literally moving in the opposite direction. And so that's why you see this kind of, it looks like it's maybe stalled out a little bit, the decrease in, when you look at the monthly numbers especially, the decreasing trend has stalled out, a little bit of an increasing trend, but it's all concentrated in services. So when Jerome Powell, the chair of the Federal Reserve Board of Directors, went to Congress a few weeks ago, there was a lot of focus on jobs and on the jobs report from January and what was about to come out in February, which now we know. In January, the jobs report, 500,000 jobs. That's a lot. That's a really hot job market. And then in February, it came in at 311,000. And while 311,000 is obviously less than 500,000, it was maybe 514,000, I think, for the previous month. This is still pretty high. 311,000 actually pretty high. It would not have given the Federal Reserve, who's looking at interest rates to keep inflation under control, would not have looked at the February jobs report as a comforting sign. But it makes sense then to look, where are these jobs coming from? And when you break it down by industry, you'll see that the number one increase was leisure and hospitality. In fact, it was a lot bigger than the other sectors. And in manufacturing, we actually saw jobs go down, not by a lot, overall 4,000 nationwide. So the number of jobs in manufacturing went down. You can kind of see a bit of a pattern emerging here. The prices of goods going down, and those who make goods, the jobs market definitely has cooled off. Price of services going up, leisure and hospitality being a place where the jobs market was pretty high. And in terms of where the jobs market is hot, obviously you're going to see rising costs and therefore rising prices within it. But here's the thing. We shouldn't think of the anti-inflation monetary policies that the Federal Reserve engages in as being like a light switch. Not everything happens at the same time. In fact, it's better to think of it as a cascading, or maybe even like dominoes. And when they push that first domino, which is increasing interest rates, it affects things that people buy on credit first, things like houses. We definitely saw the housing market go down. Things like vehicles, we've definitely seen the vehicles, in fact, one of the biggest decreases in terms of the goods prices was in used vehicles. People borrow money to buy vehicles. It makes sense that that's the first place that gets hit. And then what happens is inflation goes up, the price of goods would come down earlier, cooling off the jobs market that is most closely associated with those goods. So there's kind of dominoes falling. But services people buy in smaller increments, and if they buy with credit, it would be something like a credit card as opposed to taking out a mortgage, for example. Interest rates will obviously impact those areas as well, but because there's smaller purchases, it's one of the last things to get impacted by inflation. And so that really does start to tease out a bit of a pattern, which is pretty close to what you would expect to happen. Interest rates go up, it cools off the things that people need to borrow more often for in order to obtain, and that cools off the parts of the jobs market that are associated with that, with those activities. But it hasn't hit services yet, and we wouldn't necessarily have expected that it would have hit services yet, but there's no reason to believe that it won't eventually get there. It's just that that domino hasn't fallen. So if you're to go back a year ago, yeah, probably the Federal Reserve would have expected to have been further along at this point. But the fact that things are happening in the order that you would expect, I think, does indicate that the strategy of keeping inflation under control and the method that they're doing that, it is eventually going to play out the right way. In other words, inflation will come under control. The question is, how bad will it hit the economy when that happens? Well, our labor force is too small for what is needed today, and this is going to protect us from some of the downsides, what would have maybe happened in previous generations under these same type of scenarios where you have more jobs than people. Well, at that point, you see things move a lot faster. But now our labor force has not recovered from pre-pandemic levels yet. Labor force participation rate is still below what it was before the pandemic. And this is one of the things that I think is making this whole process move a little bit slower. The Federal Reserve clearly tried to reset expectations a few weeks ago before Congress when they said that maybe interest rates would need to be increased more and faster than over this calendar year during 2023. They'll do whatever it takes, he said, but to get inflation under control. But something has happened in the meantime, which is a couple of bank failures. Those bank failures, well, they're not typical banks. They're both banks, Signature Bank in New York and Silicon Valley Bank in California, were both banks that had very unique risk profiles. So I think they're not indicative of the entire banking market. But when they failed, one of the reasons that they failed is because they needed liquidity, and when they cashed in their investments, those investments were depreciated in value because interest rates went up. So interest rates go up, the net present value of bonds goes down. They needed the cash, and they were forced to really realize some losses at that point. So the bank failures will probably give the Federal Reserve a little pause, or maybe cause them to be a little less aggressive, and maybe take some comfort in that while things are moving slower than they were hoping in terms of getting inflation under control, the order of things that are happening are not too far off from what you would expect. So I think as we move forward, that's the big question: is does the Federal Reserve, in their fight against inflation, take a more moderate approach like it looked like they're going to a few months ago, a more aggressive approach like they had signaled in congressional testimony, or do the bank failures give them reason to pause and maybe revert back to that less aggressive approach? Only time will tell how that turns out. But overall, I still remain pretty confident that while this is a slower progression of events than what would have been hoped, it is still the same order that we would have expected, and therefore there's reason for some optimism that sooner than later, inflation is going to get back to a more comfortable level.